Okay, folks, welcome back. This is the 8th and final teaching for the second month of the ICT Mentorship. This is month October. We're dealing specifically with market maker traps of false breakouts. And we're going to talk about specifically in this teaching one side of the marketplace, just for the sake of saving time. Everything that we show you will be just a reverse of everything that's been shown. So a false breakout above price consolidation. This condition generally manifests in primary bearish markets. In other words, if the market's in a downtrend or if we're presently trading lower or expected to trade lower, a false breakout above the consolidations is reasonably expected and generally what you see manifest itself. At some measure of equilibrium in price, the market will move into a trading range. Neophyte traders or breakout traders will bracket the trading range in price with orders. That means they're going to have buy stops to break out on a buy above the old highs, or sell stops below the old lows to sell short a break below the old lows. In other words, they're trying to capture a trend, and they're going to put a buy order above the marketplace and a sell order below the marketplace because they absolutely have no idea what's going on. Or breakout traders, they just want to bracket the marketplace like long-term trend followers. They don't mind taking a lot of losses with the hopes of eventually catching a large trade. But market makers will typically send price above the range to neutralize buy stops. So they're going to focus primarily on one side of the marketplace. And again, assuming that the market is primarily bearish, that's what the market maker's MO is going to be. Okay, their playbook is to run the buy stops above the marketplace. Now, a false breakout below price consolidations is obviously the opposite. This condition generally manifests itself primarily in bullish markets, and at some measure of equilibrium in price, the market will move into a trading range. Neophyte traders and or breakout traders, again, will bracket the trading range in price with orders, again, looking to focus on buying on a breakout or selling short on the breakout. They're not privy or astute enough to know what direction. They just simply want to react to whatever the market gives them in terms of breaking out above or below. But the market makers will typically send price below the range to neutralize the sell stops. So graphically, what I'll show you here is a breakout trader or a neophyte trader's perspective on a market that goes into a trading range. Above the old high or recent high, they will have buy stops for long breakout traders. And anyone that would be short, obviously, their buy stop would be resting above that high. And below the lows, there would be sell stops for long traders and sell stops for short breakout traders. In other words, they want to capture a move that would hopefully continue going for a long period of time lower. They would like to get short on weakness. And obviously bulls would like to be, when they're breakout traders, they want to be buying on strength. They think by breaking out above an old high, their buy stop would trip them into a long position, and their belief is that they're going to hopefully capture a long-term trend up. Now, from a market maker's perspective, we look below the marketplace when we have lows in the form of sell stops. Now, I'm going to focus primarily on a buying environment, okay, focusing on when the market is underlyingly bullish. Everything that I show you here would just be reversed for when the market's bearish, okay, just to save time. When the market breaks below the consolidation, those sell stops are used to pair long orders. Now, who's buying those sell stops? It's smart money. But what types of orders rest above here? If we know below the marketplace it's sell stops, what's resting above the highs? Buy stops. So naturally, as the market moves away from those sell stops being ran out below the consolidation, they're going to expand price. Think of IPTA now. They're going to expand price up to the liquidity above the old high. So those buy stops are going to be used to pair long selling. In other words, they're going to scale out their long positions or take some profits. Eventually, the market will go into another area of consolidation or another trading range. The market drops below that trading range to take out the sell stops below the consolidation. Now, as soon as this happens, the thought process should internally be going on inside your mind with, okay, they've already shown a willingness to take the sell stops below 108.55. Now they've rallied price above the 109 big figure. We've retraced a little bit, okay? So if they are taking the market below this short-term consolidation, they're probably going to run the price higher. So where would those objectives be? What's resting above that old high? Buy stops. So if they're taking the market below a consolidation, and our understanding or expectations is the market is bullish, they're taking the market below the consolidations to run sell stops out. The only reason why they're going to want to do that is to absorb those sell stops to be counterparties for their longs. When they are long, when smart money's long, how do they look to exit their positions and book a profit or hedge? They have to get out at a place where there's willing participants to buy. Buyers are always above the highs, either in the form of a buying breakout or buy stops on short positions. That's where the liquidity is. Remember that market paradigm shift that's been spoke about in this mentorship? Well, we're talking about it here again, just using it in terms where you can see how it's applicable in price. Price runs above that old high, and now we have two areas at which the market makers have booked long positions. So now they're pricing in a buy model. So as the market moves higher, okay, they're going to liquidate some of their positions to hedge, and they're also going to liquidate positions that those traders on the bank level are actually speculating for profit. So this is how they actually take their trades and put them on, and how they scale them off, where they're placing their entries and where they're placing their limit orders to get out with a profit. But what's over here? What rests above that? Remember I showed you in the first month of this mentorship in September, specific things to look for. Clean highs and clean lows. Well, there's an area right over here that have clean highs. Above from where we're showing right now, after that 109.15 level has been hit, there really isn't much in way of liquidity voids or pulls that would be of much of interest, except for those stops right above those equal highs. As you can see, price expands. Think now in the interbank price delivery algorithm, it's going to expand up and it's going to seek liquidity. That's what we see here. Then what happens? Price invariably will go back into a consolidation. Now, what's the underlying condition of the marketplace? It's bullish. Why? Because they keep taking price below and then rejecting that, absorbing the sell stops and expanding price higher. Is there any reason to suspect that price could go higher? Look at the price action you see here. You see anything that jumps off at you? If it doesn't, we'll come to it as we move forward in this example. But we have a consolidation in here. Our reasonable expectation would be to see price seek the sell stops below the consolidation. Price does in fact go below the consolidation. What's above this old high? Liquidity. Now, do we always look at the old high, or what do we look for? Do we consider the wicks? We can, but primarily all the volume is seen in what? The wicks or the bodies? The bodies of the candles. So the body of the candles has the most volume, so the liquidity is going to rest above it. So if they took the stops out below the 108.95, they're going to look to run price higher in the form of 109.40 or higher. But initially we had that short-term consolidation. The buy stops resting above that. They could scale off a position right there. And the next objective would be 109.40. As you can see, 109.40 is swept, moving just above the bodies of the candles. Note the way that the orders are stacking higher each time. When they buy, they're buying a little bit higher each time, and they're working their orders in and still offering opportunities to scale off and profit. So the hedgers can work this model. The speculators at the bank level can work this model, and they're also providing liquidity for those individuals that want sell stops to be activated if the market goes down to those positions. And Those individuals that want buy stops above the old highs, they're happy because their liquidity is being provided as well. So think, remember that market efficiency paradigm? You have to think like a market maker. Now we have a larger trading range. Now I've kept that area of which old buying was done at 108.95, but now we've moved into a larger range. Nothing's changed here. The model is still bullish, so we see market action trade below that consolidation. It trades down into 108.85. So with that movement down into that level, where is the liquidity at? Above the old high at 109.45 or so. That's what you have up here. So what is it specifically? Buy stops. So we have willing buyers that are waiting up there for price. Once it gets there, they're buying. Smart money's buying at 108.90 or 108.85 in that area, and they know that there's going to be willing participants to be buying it from them when they want to sell it for a profit at 109.45 to 109.50. So 109.45 to 109.50 is hit, so the buy stops are used to pair long exits. So now look at what we have here. We have a wonderful example of how using consolidations with the expectation of viewing the market with that market efficiency paradigm I spoke about, where we think like a liquidity provider. We can still speculate, we can still hedge, we can still make a profit using the same model. It answers all of the problems as it relates to trading, but specifically it offers the answer to liquidity providing. Buy stops are activated and they're actually given the ability to be effective, and sell stops are the same way. So what the market makers do, we can vilify them. We can say, oh, those rascals, they did this to me, they did that to me. Okay, but what they're doing is their job. They're providing liquidity. The absence or lack of understanding that traders have, they attribute that as those guys, they did it to me. And they usually misappropriate that to their broker. But what it is the market maker is providing liquidity. And if you understand how the market seeks liquidity, that's the number one driver in price action. The market will always seek liquidity. And where is the most recent area of liquidity that's been untapped with the least of resistance getting to it? And that will give you the directional bias when you're a trader. But when you see markets go into consolidation and you have an underlying directional premise, or you arrive at one based on studying the market like this, you can quickly ascertain trade setups and signals will jump off the chart at you by way of looking at it like this. Again, we have to look at price with that market efficiency paradigm. We do not look at it as give me a buy and a sell. Okay, think like the market maker. If you had complete control of price, where would you drive price at to allow other traders to get in and at least facilitate their trades? And at least, whether they're right or wrong, that's not the problem here. Where's the buyers and where's the sellers at? And if we look at the market in this scope, in this perspective, we'll know that we'll always have buyers above old highs and we'll always have sellers below old lows. So if we know that that's where liquidity rests, all we have to do is discern whether or not does the market want to seek the buyers or does it want to seek the sellers. And the way you get that indication is by studying when they go into consolidation, which side of the market they're reaching for, and then where's the market going after it happens. And here you can clearly see every time there's a consolidation, the market seeks the liquidity below the marketplace. And once it absorbs it, it quickly runs the other direction. Why is that happening? Because the market makers are facilitating their long positions and building a buy model in the price or in this asset. So we can expect to see every time the market goes below these consolidations, these movements below it are always going to be viewed in our eyes as a false breakout. So the false breakout that would trip up traders otherwise or knock them out of profitable positions if they would have been remaining long, we can view the marketplace with the market efficiency paradigm seeing it as a provider of liquidity, see it just in the same scope or perspective as a market maker does, and then we're suddenly in line with the market maker. We're not beating the market maker. We're not trying to outsmart the market maker. All we're trying to do is get in line with what their motive would be. What's their MO? How are they going to book the market for this particular day or for this month or this week? Okay, how are they going to do that? And by looking at the models that we're showing here with looking at ranges, and when they break below the ranges and we see willingnesses to rally after that, it gives you your first telltale clue. Every time the market goes into consolidation, expect every drop down below an old area of consolidation, expect that to be a false breakout, and anticipate accumulation of long positions. And in the market, once they can accumulate their long positions, then they will reprice the market higher, running for the buy stops above old highs. But what else do you see here? I mean, if you're looking at this, what else, if you were to study this for a moment, and I'm going to ask you to pause the video, study this for a few minutes and see if there's anything else that jumps off the chart at you. And don't be discouraged if once I show you what it is, if it wasn't apparent. This first price swing from the first initial false breakout below the old lows and consolidation, once that rallied up, and we gave another area where we can buy again at that 108.75 level, that red area, if you will, I guess it's red, it's a measured move from that same buy, and it gives you an approximation of where the algorithm will reach for to offer price. And we see it reach up into that 109.25 level from 108.75, which is the measured move from the initial low that it ran up and created that first red box in the first impulse price swing. The second leg in price higher is equal to that first one. Also, the larger price swing from that first initial buy all the way up to the intermediate term high or the midpoint of the overall price swing, once we had that larger consolidation and it went down and traded into 108.85, when that happened, that same measured move from 108.50 up to 109.45 or thereabouts, that same measured move from the stop run at 108.85, that gives us a projected run up to that 109.80 level. And you can see that was handsomely hit. And ultimately, that 109.90, as we spoke in real time at the time of this recording in the mentorship, which we spoke about, that 109.90 level being directly linked to the bearish order block on the daily chart. And all these things coalesce. They start to come together. They dovetail beautifully. But understanding each individual component will help us bridge that vast chasm, if you will, of what goes on past the right edge of your chart. You see a lot of times where I'll talk about things and I'll give you scenarios of what I think is going to happen, but specific levels that I think is going to go and be hit. The reason I'm able to do that is because I'm looking at the market just like I'm showing you here. I'm looking at how the market maker is booking, how is the market maker manipulating price, what side of the marketplace are they working on, where are they punishing those that are less informed, okay? And if they're seeking one side of the marketplace over and over and over again, and they keep expanding price away from it, in this case, it's been the sell stops being ran. Every time the sell stops would be ran below a consolidation, it runs higher and it goes to the buy stops. That's the easiest way to see if we're really in a bullish market or a bullish market profile. It's not as easy as everyone says with the textbooks where you draw a trend line, it's sloping up, and just every time it touches the trend line you buy. No, you got to look at where the orders are going to be residing, and it gets back to that market efficiency paradigm. By having that model in focus, when you look at price and when you see market consolidations, when it breaks below that and you start seeing the market trade higher, every time the market goes in consolidation, they're priming the marketplace to allow sell stops to build up below those consolidations. And obviously what we've shown here was just for a buy side. If everything was reversed and we were seeing consolidations and the market rally up, taking the buy stops out and then quickly running lower and then moving into a new consolidation and then market running higher, running the buy stops and accelerating, going lower again, everything would just reverse itself in terms of everything we've explained here. So I hope this has been insightful to you. I look forward to our third month in the mentorship. So get your notebooks ready, because there's going to be a lot more information by way of price action, and we're going to be focusing in on detailed concepts that has been shown in the free mentorship, free members area on my website and on the videos, but all the gaps that I left in that free area of teaching, I'm going to fill that in as we go forward. So with that, guys, I wish you good luck and good trading.